week's training program on, on financial planning and bookkeeping. It is an interesting one, and we believe that at the end of the program, you will be able to learn yet another way of adding value to your business system. At the end of this session, we expect that everybody who participated in this program should be able to understand financial planning activities. Not just should they understand that, they should also be able to differentiate long-term from short-term plans. So in course of the training program today, you will identify what are long-term plans and what are short-term plans. You should be able to also understand reasons for bookkeeping. Right from when we were children, we have had a lot of people talk about bookkeeping. So today, we are going to know what is bookkeeping and reasons for keeping books. And we'll be able to identify methods of keeping books. Who is a bookkeeper? Those are some aspects of the things we will look at today. And we'll also look at how to record financial transactions. I think this is one of the crux of today's training. We are going to look at how you enter your financial records and how you balance your books at the end of the day. So as a form of introduction, let me help you to see that for any healthy and successful business, books are an essential aspect of it. So if you're not able to keep books, the health of your business cannot be guaranteed. Why? It is just like someone who drives. If you're driving a car and there is no fuel gauge, imagine that you're traveling from Abuja to a place like Rivers, Lagos, or any other states that is far away from here, and your fuel gauge is not showing you. What will happen to that your journey? Maybe you travel to a place where there is no filling station around, and eventually your fuel got finished. That is exactly how it is without keeping books in operating a business. Then it could also be compared to traveling to that kind of a distance where you don't know the destination and you do not have a map. What will you do without a map going to a place you don't know? You can even travel far away from that environment. I remember a time I was traveling to, and we're going to Auchi, but we didn't have a map. And the person who was guiding us was not able to identify the roads that connect us to Auchi. Before we know, we were on our way to Lagos. Before we stopped and asked someone, and the person redirected us. It took us more than an hour to travel on track. So that is exactly how it would be like if you do not have a financial plan. It will be as if you have lost course, and it will also be as if you've run out of gas while traveling. So why do we talk about financial planning? Financial planning is a plan needed for estimating fund requirements of a business and determining the source for the same. What amount will you need for you to run a particular type of business? That is financial planning. And how will you use the amount available to run that business? It includes generating financial blueprint for the company and for future activities. So for a person to be able to run a healthy business, it is essential that a person have a financial plan so that he can know what funds are required and how to apply the fund, what they call sources and application of fund and time paths. So you need to know where the fund is coming from and where it is going to be applied. Like last week, you may have heard the president of this country presenting a budget to the National Assembly. In it, they talked about 13.02 trillion naira as what the government expect to spend next year. That is the amount that the government expect to put into use next year. But did they just mention what they plan to spend? No, you also hear them talk about the sources of revenue, where they now mention how much they are going to sell a barrel of crude and how much they are going to get from tax revenue. And sometimes you even see them, the difference between tax revenue and crude. Where would they source funding of such projects from? You now see external borrowing. So that is exactly what is required for a person to be able to run a smooth business. So you all who are listening to me, you are aware that running a healthy business requires plan. They say wherever progress is desired, change is inevitable. So if you want to run a smooth and healthy business, there is need for you to put proper plans in place for you to achieve that. So what are the objectives of financial planning? There are 4 objectives of financial planning that we are going to talk about in course of our discussion this morning. Ensuring availability of funds. We've said a lot about availability of funds, because if funds are not available, then where will you spend from? And also estimating the time and sources of fund. Time is essential to the success of any business. You cannot tie money down for a long time without it generating anything to you. It will not be healthy for a business. Then generating capital structure. When we talk about capital structure, although it will be explained later in detail, we are looking at, will there be debt financing? Would there be asset financing? Would there be equity financing? So those are the things that we are going to talk about. And we will talk about avoiding the other things that can hinder the prospect of having a smooth financial plan. So there are processes of financial planning. We will look at 2 of them today. 2 processes. One is a long-term financial plan. When they say long-term, what are we talking about? We are not talking about something that will last for just a year. We are talking about something that will last for a longer period of time. And it is called strategic planning. For you to achieve a long-term goal, you need to plan ahead. That is why it is called strategic. In Nigeria, we have long-term, we have short-term, we have medium-term. Most time and again, we hear the government talk about medium-term expenditure framework. So what do you call a long-term plan? How long will a plan stay for it to be termed long-term? Anything that lasts from 3 to 7 years, it is looked at as strategic. It is looked at as long-term. But anything that falls within 2 to 3 years, you can look at it as medium term. Even 3 to 5 years is medium term, rather. Then 5 to 7 years is long term, while 1 to 2 years is a short term plan. So long-term plans considers a number of financial activities. Among the things that a long-term plan considers is investment in fixed assets. Why is it long-term? What are fixed assets? The name have been changed from fixed assets to non-current assets, like your car. If you buy a car for the business, that car is not going to last for just 1 year. It is going to last for a number of years. For example, in Nigeria, it has been defined that every motor vehicle is going to last for at least 4 years. So non-current asset is a strategic plan. If you invest more on non-current assets like motor vehicle, like property, like plant, like equipment, then you are talking about strategic planning. Then the next area is research and development activities. For you to be able to invest, you don't just invest because others are investing. You need to know who are going to be the customers of this business that you're investing in. Who are going to be the customers? What is the demography of people that you intend to sell your products to? Are you selling to youths? Are you selling to older persons? Are you selling to children? So research and development will help you to see which area to concentrate. So if you don't make a proper research, you cannot invest properly, and that can be a red flag for your business operation. Then marketing and product development. Where is the market? Who makes, what category of people do you design this product for? If you prepare a product that is going to attract, let's say, younger persons in this country where we have a teeming population of younger persons, then that product has to be IT compliant, because young persons they are familiar and they love doing things that has to do with IT. So, and again, you also consider the persons you are selling these products to. Where do they concentrate? Are you considering cities like Lagos, cities like Kano, a teeming youth who can buy your product? So those are strategies that every person who is developing a market must look into. Then the capital structure. Will you finance the product with all equity financing? Or are you considering borrowing money to finance the product? These are the things that we are going to look at when it comes to capital structure and even sources of financing. They are almost the same thing, capital structure and the sources of financing. Will it be debt financing or will it be asset financing? So for you to be able to have a proper plan for your operation, there is need for you to support with a series of budgets. So sorry about that. So these are some of the things that we are going to look seriously into for us to be able to run our businesses smoothly. So let's now look at financial planning processes. Again, we have just concluded discussion on long-term financing. So the next area we are going to look at this time is short-term financial plans. Haven't discussed what is long-term. We have said long-term is strategic. So short-term is operational, operating plan. What makes up short-term plan? Short-term of operating financial plan specifies short-term financial actions and the anticipated impact of those actions, and typically covers a period of 1 to 2 year period. It's better. So sorry about the delay, please. We now are looking at the short-term financial plans, and we said it is going to cover 1 to 2 years. So what makes the components of short-term financial plan. Short-term financial plan is in something like budgets. Remember, every year a person is expected to prepare a budget of a 12-month period, and we have said 1 to 2 years. So since it is a 12-month period, then it falls under short-term financial plan. What about operating plans of day-to-day running? You have people who prepare to-do lists for the day. It also falls under short-term financial plan. Now, planning is not just about long-term or short-term. We also have cash plans, because you need to know how much is coming to you and how much you are going to spend in a year. So in cash planning, we are going to look at cash budget. The cash budget is the statement of firms' planned inflow and outflows of cash. Inflows and outflows of cash. How is the cash coming in and how is the cash going out? In accounting, this is designed on a statement called cash flow statement. You're going to know how cash comes in and how cash goes out. That is in a cash flow statement. It is also used to estimate short-term cash requirement with particular attention to anticipated cash surpluses and shortfalls. So with your cash budget, you will know whether you will have surplus of cash or you're going to have shortfalls of cash within the period. So you can now see that cash planning is a very essential part of every business. As you receive the cash, what are you going to use it for? Where is it coming from? Are you going to sell goods? Are you rendering services? So those are the things that cash planning can help you to achieve. Typically, cash planning is the monthly budgets that are developed and carried out yearly. It covers a yearly period. So whenever you are developing a cash budget or cash plan, you know it is going to cover a yearly period. Typical of this is what we have in Nigeria, where every year you hear the president presenting a budget to the National Assembly, and they are going to check how was the budget used for last year. That is what they call budget performance. You now check, how was the budget you made last year? How was it used? What did it achieve the intended purpose? If, for instance, it is said that in 2021 budget, they are going to spend about 48 billion on education and 41 billion on healthcare, what those monies that are called in a very humongous amount, did they use it specifically for the things that was intended to be used for? So with budget, you can plan how much that you're going to use at any given period of time. Then you're looking at the budget circle. You can now see the budget circle on your screen. We are talking about performance planning, providing a framework of reference, investigating variation. Variation is those shortfalls we have mentioned, where there is a deficit, budget deficit. Those are variations. Then corrective action. Everyone who plans wants to have a form of surplus. You do not want to have a deficit, because if you have deficit, where comes the deficit from? So you want to prepare your budget in such a way that it embraces what you intend to achieve with that budget. Then, if there are variations, you plan again on how to harmonize those variations. Then we now have strategy, planning, and budgets. Strategy analyzes two things. One, long-term planning, and second, short-term planning. We have talked about long-term planning to mean long-run budgets. And we said strategic budget can involve something like medium-term or even long-term framework. You are planning that within 5 to 7 years, I want to achieve this. After you have done that, you come down to medium-term. Okay, within 3 to 5 years, I want to achieve this. And from those 3 to 5 years achievements, you now break it down again. In this year, out of I have budgeted that I want to spend 10 billion in 7 years. So that 10 billion in 7 years, year one, I want to spend 2 billion. That is budget for that year. 2, I want to ensure that from year 1 to year 2, I have spent out of this 10 billion, I have spent 4 billion. Then year 2 to year 3, I want to ensure that instead of achieving 10 billion in year 3, I have spent only 5 billion out of the 10 billion in year 3. Then the remaining 5 billion will now be spread on the remaining number of years. So that is how plans are made. So we need to put a strategy in place of achieving that long-term plan. So long-term plan is achieved through short-term strategy. Short-term strategy is intended to harmonize a long-term strategy you put in place so that you can achieve that common objective that you have put in place. We now have circle of money. The primary function of finance is movement of money from lenders to borrowers and back again. And this is referred to as the circle of money. In the banks, you see that people put their monies in the bank. Banks use the money to give to someone as borrow the money to someone. After sometimes the bank gets you pay them on that amount you have borrowed. And after sometimes, the person who have invested the money collects back some of the money, not all, and it continues to revolve like that. That is why you see that in the banking sector, while people deposit, some collect, some comes back to borrow, the money continue to flow in that circle. So the person who is collecting will not collect everything, and the person who is giving the money to the bank will also be planning his own, and the person who is using the money, the bank who serves as an intermediary between both the lenders and the borrower, also have something that he has as return on his own investment of giving out money for the person to pay him some benefit. So this money continue to circulate like that and like that, and that is what we refer to as circle of money. We now want to move to the next aspect of our discussion today, which makes one of the strongest area that we are looking at for those of you who want to run a business. Bookkeeping is an essential aspect of every business organization. Anybody who is running a business needs to keep his books appropriately, because if books are not properly kept, it can have an adverse effect on the business. Then what is bookkeeping? Bookkeeping involves the recording on daily basis of a company's financial transaction. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. So as in transactions occurs on daily basis, as you sell every day, as you buy every day, you need to keep a record. And the person keeping this record must not be a qualified accountant to do so. Every business organization can keep a record. So if it is an individual can keep a record. If it is a big company, the company also needs to keep his record. Bookkeepers are individuals who manage all financial data for companies. That means without bookkeepers, companies will not be aware of their current financial position, as well as the transactions that occur within the company. If you do not have a book, you may be thinking that you have money when the money is finished. So that is the effect of not keeping books. You may be thinking that you are not owing anybody when you actually have some obligations to pay, when you have some liabilities to pay. So bookkeeping is essential to every business organization. To every person who operates a business, there is need for the person to keep the books of the business. What are the importance of bookkeeping? Why is it essential that everyone who operates a business must keep the books of the business? There are 6 things that we are going to look at. 1, reliable measure of a company's performance. If you keep books, it helps you to measure the company's performance. In fact, you can do what they call benchmarking, comparing your operating activity this year with those of another year and see whether you did well this year than last year. So that is a measure of performance. You can also benchmark your operation with another company who is operating the same kind of business you are doing in another environment. So you now check, for example, you are selling phones. Another company is also selling phones. And the company is doing well. So why is this company doing better than me? Because you need to keep your books together for you to know areas where the company is doing. Are they doing more marketing than myself? Are they doing more in this other area or aspect of the business than myself? So you can compare or measure your performance if you keep proper books of accounts. Then the next thing is that it provides information for strategic decision. We have mentioned that strategic decision is long-term decision. So if a company is operating without books, will help the company owner affect the going concern or the long run of that business. So books can help you to plan into the foreseeable future and will help to keep your company afloat. It can help you to provide benchmark for revenue and income goals. How? What is revenue and income goals? Now, you can plan that this is what I want to achieve as a total revenue for this year. And at the end of the first quarter of the year, you have already planned that I should be able to achieve this as a revenue. So if you did not achieve that, investigate. You check your books. Which areas am I spending so much on expenditure that are not relevant to the business? So those are the things that will guide you to keep proper books of account and help the bookkeeper to produce what can help the business owner to make an informed decision. Fulfillment of legal and tax obligation. Legal obligations and tax obligations are everyday thing in Nigeria. You need money to pay tax, and you also need to know tax liability to pay to the government. But if you're not paying your books and you are, that is where the bookkeeping authority, and they find out that what you are presenting as your tax return for the year falls short of what is expected of you, they will come to your office and do what they call tax audit. And by the time they do the tax audit and investigation and they find out that you have paid far less tax, you could even pay a fine, which would have been avoided if you have kept a proper book of accounts. Principal among the importance of bookkeeping is that it provides stewardship to the investor. The investor is the business. So sometimes the persons who are running the business are different from the business owners. So if you are running the business and the business is being run by some other person, the books that that person is keeping is what will help you to know whether the company is doing well or not. As you go through the books of the person, you will now know whether the person you have entrusted this responsibility to is accountable to the responsibility you have given him. That is stewardship. The person owes a fiduciary responsibility toward the business owner. So if there are no books, on what basis are you going to assess whether the person you have entrusted this responsibility to is doing well or not? So you can see that for the success of any business is a function of keeping appropriate books. And it can also help to, lastly, cash flows. We have mentioned cash flow earlier, that it is inflow and outflow of cash. So proper bookkeeping will help you be able to make a proper projection into the future, and it will help you to manage your finances properly. Now, we will now move to the next aspect of our discussion, which is accounting basis or basis of accounting. Basically, we are going to look at two bases of account. One is the cash basis. What is cash basis of account? Cash basis of account records transaction only when cash is actually received or paid. So in cash basis, if you're owing somebody, it's none of your business. You do not keep records. You're only interested in when you have given out cash and when you have received cash. Then the second aspect of basis of accounting that we are going to look at is accrual basis of accounting. These records transaction when it occurs, even if cash is not received or paid. You now see that when you earn a cash, let's say that you are selling a product, a customer come to buy the product on credit. You have carried the product to the customer have started using the product. In accrual accounting, you are going to have receivables. These are things, this is an amount I am going to receive from this customer. So you need to recognize it as sales that has already been made. And how will you do that? You are going to credit your revenue, and you are going to debit your receivables and credit your revenue. Receivables means debtors, those that are owing you. So you are going to debit those that are owing you to show that you are receiving this amount from this person, and you are going to credit your revenue. Then let's look at an example of accrual accounting. You purchase 100 units of a product and will pay next month. You have not paid anything. Your cash balance remains the same. But how will it be recorded if it were to be a cash basis of accounting? If it is a cash basis of accounting, no transaction will be recorded, even while you have purchased those units and you are going to pay for it next month. It is only that next month that you pay that something will be recorded. So this month that transaction was entered, nothing will be recorded. But in accrual accounting, the transaction will be recorded as payable. That is a liability. You have an obligation to pay this person by next month. So this month, you will recognize it as something you are owing that you're going to pay next month. So that makes accrual accounting to be a little more comprehensive in reporting than cash basis of accounting. It helps the business owner to see in a holistic way what the business position is at any time. Methods of bookkeeping. There are two methods of bookkeeping. The first one is single entry bookkeeping. It's a little more straightforward. Single entry bookkeeping is where an entry is made for each transaction in the books. Just one straight entry. If you sell something, you record it as sales. Everything self can appear in just one book. That is single entry bookkeeping. But a more justified and good presentation of bookkeeping is the double entry bookkeeping. Although these will be required, that someone who has a knowledge of accounting can help you to design this double entry for your operations. For example, in double entry bookkeeping, it is a little more robust. It follows principles that every transaction affects at least two accounts, and they are recorded as either debits or credits. That means that every transaction that occurs in your operation, there must be a giver and a receiver. In accounting, it is said you debit what comes in and you credit what goes out. And it is always said that to every debit entry, you must have a corresponding credit entry. That means anything that is given, there must be a giver and a receiver. How do we understand this in a simple way? let's say that you sell a bag of cowpea or beans to someone for 20,000 naira. So the two accounts in double entry that will be affected is cash or bank account that represents the person who is selling, and sales account. So you are going to debit your cash to show that you have received money from sales, 20,000, and the actual amount that you receive is what sales gave you. So sales will give you 20,000, and you're going to record 20,000 as cash, as your own, or in your bank account. So everything that goes out, there must be a giver and a receiver. So in this case, who is the giver? Sales. Who is the receiver? Cash. And how much is the transaction cost? 20,000. So 20,000 goes out of sales, and who is receiving the 20,000? Cash. So that is double entry bookkeeping. A more complex bookkeeping can, double entry bookkeeping can come in when there are complex structures. But at this stage, it may not be required for you to get into such detailed, complex bookkeeping. Why? Because you need to keep your books straight, and just anyone who have a little knowledge of accounting can help you to put these books in order. Although there are areas where a more professional approach may be required, and we are going to get to that in due course. Now let's look at accounting system. Accounting system. Accounting system is two. It's either you are using manual accounting system or you are using a computerized accounting system. Manual accounting systems are those that are processed by hand. Everything that enters your company must be recorded, and that records will be done by the person who is writing. So the person who is writing will be the one to write whatever transaction that has occurred. Like that 20,000 naira that we said, if the person is selling coffee, the person is going to debit cash and credit sales. You are going to write it down. You are writing down in cash, and you're also going to write it down in sales. It is easier for you to operate manual accounting system when the business is very small, the one that is run by one person, and the business is not too big. You can easily get someone to write down some things, and it goes like that. But the one that is a little more complex, like companies who operate different branches all over the world, it will require a computerized system. This means that the financial information is recorded by entering it into the computer. There is an advantage of entering this financial information in computer. The advantage is that it minimizes error. The error in computer system is minimal, because whatever you give to the computer is what the computer brings out, and the computer will not make mistake. Let's say, for example, there is a spreadsheet. Please. One. Please, my apologies for the network problem. It is one of the things on home. So as we're saying, please, you're muting me. So if you have recorded the information in computer and you have told the computer submit, anything you have entered in the computer, it will give you the accurate sum. There will be no mistake. So that is the beauty of using a computer and recording the information. When we put our operations into the computer, there is this word that you often hear people say, garbage in, garbage out. Whatever you have given to the computer is what the computer will give you back. That is garbage in, garbage out, GIGO. If you put 5,000 naira into the computer will also present 5,000 naira to you. But if we now computerize our program, would there still be need for people to work with you in the company? Because you may think that if it is computerized, you don't need humans. There is need for humans to impute these things into the computer, because the computer cannot impute it by itself. And the person who is imputing it into the system must have basic bookkeeping knowledge. The person must have an understanding of bookkeeping. Because if the person does not have an understanding of bookkeeping, he may not enter the right information. If you do not have an understanding of bookkeeping, it will mean that you will not enter the right information. And if you do not have enter the right information, you will be given the wrong information about the company. For example, in that copy we said, and you are supposed to credit sales and debit cash or bank. You now credit bank and debit sales. You have reversed the transaction. Instead of saying that you bought, you sold this and you got this, it is now meaning that you have you bought this and this is how much you gave out. So it could be very tricky if you're not able to put the right information in the right place in the computer. So that is why it is reasonable for anyone who is operating a computer program that is designed to carry out accounting transaction to have basic knowledge of accounting operation so that he will enter the right information at the right time. In accounting system, there is something they call GAAP, Generally Accepted Accounting Principle, or Generally Accepted Accounting Practice. All accountants use the same set of rules to prepare financial reports. And the Financial Reporting Council issues these rules. In fact, it has been harmonized the world over so that everybody around the world will use the same set of accounting principle. That is why the word general is used. In Nigeria, if you are entering an accounting transaction on the debit side, it will be the same approach you are using in the UK. It will be the same approach you are using in the US. But that does not mean that each country are no longer independent to formulate certain accounting principles that can help them achieve a common objective. Earlier in Nigeria, the organization who were responsible for setting these rules in Nigeria was called Nigeria Accounting Standard Board. Using a Nigeria-specific accounting principle to a globally accepted accounting principle, they now form an organization called Financial Reporting Council of Nigeria, FRCN. So they are responsible for certain rules of financial reports. And for you to be able to enter proper books of account, it means your account has to align with these generally accepted accounting principles. Then the next accounting system we want to look at is financial reports. This is a summarized information about the financial status of a business. At the stage of reporting, remember when we were talking about bookkeeping, I did mention that just anyone can be trained to be a bookkeeper. Just anybody who has a basic understanding of English language can be trained to be a bookkeeper, and he could be skilled at it. Even a secondary school leaver can do that for you. But when it comes to reporting, when it comes to financial reporting, it now requires a professional approach to it, because you need to prepare statements not for your business alone, but for users of financial statements. So that is why at financial reporting stage, you need someone who can guide you aright, maybe an accountant to do that for you. Then another accounting system, you hear language of the business. And because it is so fundamental to communicate, that communications of business information are done using the accounting language, the accounting language is what they call business language. So the business language cannot be detached from the accounting language, because it is the accounting that reports what your business operations have been. And bear in mind that the accountant is interested in financial aspect of the business. And what people are looking at is how healthy is your financial system. So there is need for us to have a good accounting system that can help the business to grow properly. Then accounting reports. We have mentioned in passing what accounting reports are. We are reporting what we have done in the business to users. Basically, we are talking about external users of the business information. Bear in mind that we are going to talk about it in detail, who forms external users of the business and who also form internal users of the business. Because wherever there is external, there is also internal. And what is the focus of internal users? What is also the focus of external users of this accounting financial information? Management accounting or managerial accounting focuses on management information that management can use for their decisions in the business. So the focus of reporting to management, reporting information to management, it is at that time you are looking at managerial accounting. And managerial accounting deals specifically with internal users of accounting information. We will mention in detail who are internal users and what are their needs for this information when we progress. So now let's look at who uses accounting reports. We have mentioned that there are two categories of users, which is one, internal, and two, external. So on looking at internal users of the accounting information, what exactly do they need this information for? They need it to make an informed decision. You hear people say that whoever that is not informed will be deformed. So if you do not have an overview of the accounting information of a business organization, and you invest your money into the business and eventually the business fails, have you not been deformed? So that is it. So you need a holistic information about the business that you want to invest in. So basically, among these external users of accounting information, we are going to look at the government, the general public, the civil societies, and the lenders. What interests does the government have in your business operation? The business, the government wants you to pay tax. And as they want you to pay tax, they need to know whether your business is doing well and how much tax you will pay. So that is the information need of the government. They want to know whether you are doing well and how much tax you need to pay, because that is an obligation you owe to the government. Tax is defined as a compulsory levy that the government issued on the business that you're operating. So if the government does not have a good information, a good knowledge of what you are doing, you may trick them into paying less tax when you're supposed to pay higher. So that is why they are interested in your financial reports, your accounting reports. What about the general public? In the Niger Delta, where gas flaring happens from time to time, it is a threat to the general public for a company to flare gas, because it affects the environment, the immediate environment of the Niger Deltans. So the general public are interested in what you do in that your business and your financial report, so that they can demand that you do certain things for the people in that environment. During those days when there was a very serious encounter between some persons in the Niger Delta and the government over certain things, you will see that their demands were that we are suffering because you have stopped because your operation has affected our business operation. What were their business operation? Primarily, it was fishing. And when crude is exposed to the water, everything inside the water dies off. So you can now see that it was a threat to their livelihood. And because of that, they are interested in the operation of the business so that they would know the right demand to make of the business. Civil society organizations are also interested in the civility of your operation. That is why there is an encouragement for green gas emission. Do not expose the gas to the outside world because of the dangers attached to it. So civil society is also an external user of accounting information with the view of knowing what to demand of the company. Every lender is an external user to the business information or accounting information of the business. If you want to take a facility from a bank, the bank needs to see your financial reports. Why do they often ask for your financial reports? Maybe sometimes your financial statements before they even agree to give you a facility. They are doing that because they do not want their money to miss. They do not want to lose their money in the long run. They want to know whether your business is still viable, your business is still a going concern. It can still continue to exist into the foreseeable future. And will you be able to pay back what they have given you? If you have not paid back, will you be able to give them interest on the money they have given to you? So that is why lenders are also interested in the operation of every business organization. If you do not know what you are doing, they will not want to give you their money because it's risky. And you can believe with me that it is very difficult to get money these days, not to talk of leaving it in the hands of a business that is not a going concern, that have a shaky stand when it comes to its financial operation. Then a shift from external users of accounting reports. We now want to look at the internal users of these accounting reports. Who are the internal users? We have the shareholders, we have the managers, we have the employee. Why is it that the shareholders are mentioned and managers are also mentioned, while the employees are mentioned? Because they are different categories of internal users of accounting information. The shareholders are the owners of the business. They have the money and they invest their money into the business with a goal. The goal is that at the end of the year, they should declare dividends and give them return on their investments. So if you are not, if they do not see your accounting report, they will not know whether you are doing well at all. If there is need for them to change strategy, who is the manager? Should we sack this manager and bring in another person? Is it doing well? It is based on the accounting report that that manager or management has presented to the shareholders. So the major goal of a shareholder in a business is that they want to have return on their investment. And that return on their investment is a function of the accounting report presented by the management. So you can now see that they are also keenly interested. They are looking with their eagle eye in the financial operation of the business to know whether, so as to know how much dividend is declared, whether it is commensurate with the profit that was declared in that year. The managers are those who run the business, and they also need something from the shareholders. If they manage the business aright, they are going to have bonuses. They are going to be paid salaries. So if the managers see that the business is doing well through its accounting report that is presented, then they can now ask, please, so shareholders, you gave us so and so target for the year. We have beat the target. Please give us so and so bonuses. So you can see that they are interested in the operation of the business so that they can have bonuses, they can have salaries paid to them as at when due. And they also don't want to lose their job. They are there, and it is from there they feed their families. So since they feed their families from that business operation, it means that they do not want anything to tamper with the existence of the business. And if they notice that there is an aspect of the business that is not doing well, they investigate and find out what they can do to make that aspect of the business do well. That is the work of the managers. And this work is based on accounting report or financial information that is presented to them. The last set of persons that we have here are the employees. What do you pay to the employees? You pay them salaries. So, and they also do not want their business, their employment income to end. They want it to continue. They don't want to lose their job, because if they lose their job, where will they go to? So they want to also look at the accounting report of the business to see that the business is viable, it can continue to thrive, and they will continue to put food on the table, and they will continue to have their salaries as at when due. Now let's look at some aspects of accounting reports that are presented. We have 3 reports here that we will look at. We have the balance sheet, now called statement of financial position, the income statement, now called the statement of financial performance, and the cash flow statement. What is a balance sheet? A balance sheet is a list of assets and liability of the business. What the business owe and what the business have. What you have is your assets, and what you are owing is your liabilities. And there is this equation that they use in accounting, that assets minus liability equals equity. And that means equity plus liability equals assets. The left-hand side of the balance sheet and the right-hand side of the balance sheet must balance, because liabilities plus and the liabilities and equity, asset minus liability is where you have the equity of the business. Then the income statement is looking at what have you sold for the year? What makes the component of your revenue? What expenses have you made? So if you minus your expenses from your sales, you now have your income or your profits for that year. Then the cash flow statement is looking at the liquidity or the position of the company, cash inflow and cash outflow. Then cash inflow minus cash outflow gives you cash and cash equivalents, and that is the float of the business. We are going to look at it in detail. What forms the balance sheet? You can see it on your screen. The assets and the equity on the left-hand side of the balance sheet, the liabilities, sorry, and the equity on the left-hand side of the balance sheet, and now the assets on the right-hand side of the balance sheet. Now, on the income statement, we have the first segment being the revenue, the second segment being the expenses, and the last segment being the profit. This is now a typical example of how a balance sheet looks like. This one is presented according to liquidity. You can see the asset side. On this side, the asset is kept on the left-hand side, while the liabilities are kept on the right-hand side. Now, what forms the assets? There are I'll call you when I start the unit. My apologies once again. The network threw me out. So we were talking about account receivables, and we said before you used to hear debtors. That is that thing you see as receivables. Those who are owing the business, you are going to receive this amount from those who are owing the business. In this example you see here, you can see that they have cash on hand, cash that is available to them, or cash equivalent, cash and cash equivalents of $100,000, and they have account receivable, those who are owing the business to the tune of $20,000. Then inventory are stocks, things the business have in store to sell. They are also part of the current asset of the business. Then you have prepaid expenses. What are prepaid expenses? Something that you are going to pay in the future. Let's say, for example, you are supposed to be paying rent yearly and you have paid the rent 2 years. You have paid in advance. You have paid the rent for 2 years in advance. At the end of the first year, you see that you have, let's say your rent is 4,000 as it is there, as it is showing there. You know your rent is 8,000 naira. You have paid, your rent is for 4,000, and you paid in 8,000 naira for this year. It means that you already have paid for next year to the tune of 4,000 naira. So that 4,000 naira is a prepaid expenses, and it is part of what we call current assets. Investments in shares, investments in other companies also form part of the current assets. So there is a summation of the total current asset for the period. Then after that, you now move down to the other aspect of the statement of financial position, also called a balance sheet. You will see equipment. So that is non-current assets. That is non-current assets. Current assets are those assets that can be converted to cash within 1 year period. The non-current asset stays beyond 1 year period. For example, land. You cannot easily convert land to cash. Even if you have land and they say land is non-depreciable, it's going to appreciate over time, you cannot easily convert land to cash. Maybe as at the time you want to sell the land, if there is nobody to buy it. So land is a non-current asset. And we have buildings and improvements. Buildings are non-current assets because they stay beyond one accounting period, 12-year period. Then we have equipment. All these are non-current assets. And non-current assets are depreciated yearly. What is depreciation? Depreciation is allocating the depreciable amount. Let's say the value of the building is 250,000 and it's going to last for 5-year period, for example. This 250,000 on the straight line method of depreciation is going to be broken down into 5 years. So if you divide 250,000 by 5 years, each year you're going to have a depreciation of 50,000 naira. So for the first year, you will have 50,000 naira removed from the value of the building. The next year, you remove another 50,000 naira. What will be left will be how much? 150,000 naira. And like that until all the value of the building will be fully depreciated. That is why depreciation is defined as a systematic allocation of the depreciable amount of an asset over the useful life, the period that the asset is expected to last. Then we have other categories of assets that are not also current, but they are called intangible assets. Intangible assets are assets that you cannot see, you cannot touch, like trademark, like software, computer software. They are all intangible assets. So why non-current asset is depreciated, the same thing also happens to intangible assets. But intangible assets are not called depreciation, they are called amortization. The same definition that you give to depreciation is what you give to amortization. You reduce the value of the intangible asset over, if it is a finite, if it has a finite number of years, it's going to stay. You spread it over those years. Or if it is infinite, there is also a way of calculating, but those are complex things that can be done by an accountant. So that is that about the asset side of the balance sheet of statement of financial position. Then let's move to the other side of it, the liabilities. Just as the assets have current and non-current, the liabilities also have current liabilities and long-term liabilities. Remember, we said liabilities and equity equals assets. So that is what you can see on it boldly written, liabilities and shareholders' equity. So if you sum both the liabilities and the shareholders' Please, my apologies for the timeout. The network has really been difficult this morning. So we were talking about the liability side of the balance sheet. We have discussed what are current liabilities. So the next thing we are going to look at is long-term debt. They are non-current liabilities, long-term debts like debentures. They are long-term debts that cannot easily be, if they don't pay them, or preference shares. They are all long-term, non-current liabilities. Then we have the other side of it, which is now shareholders' equity. Remember that liabilities plus equity gives total assets. So if you can see the total liabilities in this example is $247,000. But that does not equal the total assets. The total asset is $472,100. So what would now form the total liabilities? It is shareholders' equities. And the shareholders' equities include common stock, additional paid in capital if the shareholders decide to increase their stake in the company by increasing their equity shares. It will become additional paid in capital. Retained earnings. Retained earnings are monies that the business had as profit, but they did not pay it to the shareholders. They retain it so that they can add it back to the business and reinvest. Treasury stocks. So those are parts of the shareholders' equity. So if you sum all of them together, it will now give you the total asset of $472,100. So this is a typical example of how the balance sheets or the statement of financial position looks like. Now let's look at the segments of the statement of financial performance. Financial performance, you have the sales. Sales, there is a comparative year there, 2003 and 2004. So 2003 is compared with 2004. Earlier, we mentioned that one of the reasons for keeping records in accounting is for you to be able to compare what you have done this year with what you have done last year. So if you look at the revenue from client service revenue in 2003, you will see that it is a total of 254,651 naira. Then in 2004, 279,156. So you see that there is an improvement in client service revenue from 2003 to 2004. So you can now see that you did well in 2004 if you're just comparing it on the surface like this than in 2003, comparing the two figures that are there. Then the organization also gets involved in sales of books. They sold more books in 2003 than they sold in 2004. So the investigation would now be what happened in 2004 that we sold less. Then professional consultation is another area where they got money from. Yes, in 2004 and 3, they have 42,127 from professional consultation. But in 2004, you can see that they have 56. It is a step on top what they had in 2003. So this is a typical example of how the income statement is segmented. You start from the sales, then you move to the expenses. From the expenses, you now see the operating income and the other side of it where you have the non-operating gains and losses. Then the expenses, what forms the expenses of every business? You have the wages, salaries. You have marketing and advertising, rents, utilities, membership and publications, insurance, consultants. You have office supplies. So those are what they spend their monies on in the year 2003 as well as in the year 2004. Comparing the 2 years, you also see that the things they spend their monies on, some of the things they spend their monies on in 2003 increased in 2004, while some reduced. So those are the things that you see in this income statement, the typical income statement. You see the sales, you see the expenditure. So sales minus expenditure gives you operating income. In 2003, their operating income was 54,703, but in 2004, they had a total of 77,290. So this is how the income statement is segmented. But below the income statement, you will now see non-operating gains and losses. Where does this come from? You have interest income. Interest income. It will either be a gain or a loss. They had interest loss in the interest income in 2003 and loss in 2004. They have loss on sales of assets in 2004. Sometimes they could also have gain. If it is a gain, it is added. If it is a loss, it is minus. And that is why you are seeing some figures in brackets. Then donations and gifts are also non-operating activities, because if you do not have enough money, you cannot give donations. So you need to donate out of surplus and not out of want. So those are some of the things that makes up the operating income. You now see provision for income tax. In 2003, there was a total income tax of $21,881, while in 2004, $30,916. Now, this is where the government is interested. You remember when we talked about users of financial statement, the government wants to know whether what you have presented is true. So if your books are not properly kept, they will come for an investigation to know whether what you have presented is true or false. Then there are basic components of these financial statements. Everything in it anything you use in your operation must fall under one of these categories, these units of accounting information. It is typical to see every aspect of this in a general ledger. Units of information that are presented in the business record must fall under either assets, liability, equity, revenue, or expenditure. So there is no transaction that happens in a business that does not fall under one of these accounts. It's either it is an asset, or it is a liability. It's either it is equity, revenue, or expenses. So your books must present your information in any of these categories that are highlighted here. Accounting is a process of recording these business activities that makes changes to accounts, and these include sales of a product, revenue from service earned, buying products or services, incurring other expenses, depreciation of fixed or non-current assets, and closing books of accounts. So this is what you do in accounting. There must be either sales of a product, revenue from services you rendered. If you have rendered a service, you also earn something from there, like we see in that example of a income statement where we see revenue from consultancy. Revenue from consultancy, as it is here, you will see revenue from professional consultation. Revenue from professional consultation falls under the category of revenue from services earned. Buying of products, now you are talking about purchases, income, incurring other expenses like paying of salaries and every other thing. Then you now have depreciation of fixed assets. They are all aspects of accounting processes that must be kept. And when any of these and other business activities are recorded properly, accounts may either increase in value or change in value. Let's now go to the double entry aspect and see how it is done. For any business transaction that happens, two or more accounts are affected. There is a give and take of equal naira amounts. We have shown this earlier on how you debit and credit. And that is what we call double entry principle. There are two types of actions done to account to bring the values down or up in every accounting transaction. There are some aspects of accounting transaction that if you debit, it increases the value. There are some, when you credit, the value increases. Whether an account grows or shrinks when it is debited or when it is credited, it now depends on the type of account that is operated. For example, a debit to an asset account makes it bigger. So if you want to increase an asset, you have to debit it. Let's say, for example, if you had a motor vehicle costing $50,000 and you want to increase the value of that motor vehicle or a building, you add 10,000 to it. If you want to add 10,000 to that 50,000 naira, it means that $50,000, it means that you have to debit it. So when you debit, it increases the value. Instead of the value of that motor vehicle to be $50,000, it will now become $60,000. If you reverse it, let's say you credit the motor vehicle with $10,000. Instead of the value to remain $50,000, it will drop to $40,000. So that is exactly how it is. And the opposite happens in crediting for liabilities. If you credit a liability, it increases. When you debit a liability, it reduces. An asset, if an asset is debited, it increases. If it is credited, it reduces. So a liability, if you credit it, it increases. If you debit it, it reduces. What about revenue? How does revenue react in these accounts? Revenue reacts the same way with liabilities. If you credit a revenue, it makes it bigger, it increases. Whereas if you debit a revenue, it reduces. Expenses react like the assets. If you debit an expense account, if you debit expenses, it increases. While if you credit an expenses, it reduces or gets smaller. Equity reacts like other liabilities. If you credit it, it increases. If you debit it, it reduces. All these transactions, entries are done in what is called journal entry. Again, my apologies for the unstable network. So this is a typical example of how it reacts to the different debits and credits entries. If you check your left-hand corner, you will see the balance sheet. And the balance sheet is also called statement of financial position. Assets, debits, liability, credits. When you debit an asset, it gets bigger, it increases it. When you credit a liability, it gets bigger, it increases it. When you credit an equity, it gets bigger, it also increases it. Then to income statements, there are two segments of the income statement, revenue and the expense. Sorry, we'll get there with time. Again, I want to apologize for the network outage. It's not really been easy with the epileptic network we have around here. So the income statement is what we were actually looking at. How do you get the income statement increased or get it bigger? We have only two aspects of it. It's either revenue or expenses. And we said revenue, for it to get bigger or increase, you have to credit it. Then to reduce the revenue, you have to debit it. Sorry. It's been terrible here today. So we were on the liabilities, that if you want to reduce your liabilities, that you reverse what you did to it before now. Before now, we said that if you want to increase your liabilities, that you credit it, as you can see on your screen. Now we want to reduce its liabilities. So you go back and do the opposite. You debit liabilities. If you want to reduce your equity, you also debit the equity. If you want to reduce your revenue, you debit your revenue. If you want to reduce your expenses, you debit the expenses. So those are the things that you do at each category to make sure that your accounts are properly maintained. It's either it is debited or it is credited. And you sum the position of your account on the balance sheet: assets, liabilities, equity, revenue, expenses. That summarizes everything that you need to do in your accounting transactions. It's either an account is what the transaction is an asset, it's either it is a liability, equity, revenue, or expenses. I want to sincerely apologize to you for the unsteady network that has really hampered our smooth discussion for today. So this is where we will come to the end of this discussion this morning. Thank you very much. Now it is open to all of you. If you have a question, please, you can feel free to ask. Yeah, if you have a question, suggestion, or anything on the discussion, please, you can unmute yourself and speak. Sorry, is anyone speaking? Yeah, Mr. Emmanuel, are you speaking, please? Can't hear you at all.
Yes, I'm following, sir. But I didn't get everything due to the unstable network. But I think I'm a bit familiar with some of the terms. So with that, I think I understand what you're trying to lecture for today's class.
Okay, thank you very much.
All right, thank you, sir.
You're welcome. Any other comments or question, please?
Just like Mr. Emmanuel said.
Okay. Oluwatosin. Can we hear your comments, please? Mr. Anthony. Eze Cordelia Tochukwu. Namsa Bitrus Emmanuel.
Thank you so much, sir. Everything was self-explanatory. So thank you. I don't have any questions for today. Thank you, sir.
You're welcome.
Yes, sir.
Nelly Williams. Ugoche. And Ruben Choyin.
All right. Yes. Please, thank you for.
Can we hear your comments, please?
All right. Can you hear me? Yes, I thank you for the lecture. It was quite educative. Although they had some network challenges, I couldn't follow all through. But I think what I got, I really learned a lot. But I have a question about the use of accounts, uses, why we use accounts, why it can be used for both internal users and external users. Now, I want to ask whether these account records can be used negatively. Is there a way to prevent that? Is there a way to prevent such? I don't know whether my question is clear. Oh, no.
Can you come again with your question? The network just threw me off again.
Okay.
Yeah, let me hear you, please.
All right. You talk about the purpose of the uses of accounting reports, which can be used by internal and external.
Yes.
Now, yes, I want to ask, as good as the purposes are, can these accounts still be used for negative purpose that will rather harm the corporation or the company? And if it is there a way of preventing that?
Negative purpose, you said.
Yes.
Like, I don't really understand what kind of negative purpose it can be used for.
And well, of course, we're in an economic world where there's competition.
Yes.
Yes, where there's competition, and some records which could have been used to rather build the company can rather be used. Maybe, I don't know whether they can, when you talk about competition, maybe you have another corporation which seems to do the same thing you are doing, and somehow they want to lay hold on some key records, so if that is made very open, is there any way it can affect the organization? I don't know.
Okay. If I get you, like, the financial reports you produce, yes, and send for people to see, even the general public, they do not contain your blueprints. It is just a summary of your operation. And if you get me when I mentioned that even you as an organization, as the owner of an organization, you can benchmark your operation with another similar organization.
Okay, yes.
You can compare your operations. You can now say, oh, I am into production of this and that. There is another similar company producing similar thing, and they are doing well. So what areas are they doing well? What are they doing that I am not doing? So those are the areas that accounting information are used for.
Okay.
But in an environment where anybody can use anything for anything, there is also where you have a cover in the system where you have a protection that the intended users of the financial statement are defined by law. So somebody cannot just pick the financial statement and say it deceived me. That is why there is even need for any company that ends in PLC to hire external auditors so that they can append an opinion on what you have done and say this thing you have done shows a true and fair view. So there is an excuse of liability if somebody picks up the financial statement and say this is why I have made this mistake, so you have to be sued for it. But apart from that, it is a public document. You even file it with the Corporate Affairs Commission. So nobody can use it for any sinister purpose, apart from using it to compare with their operation.
It's understood.
All right.
Thank you, guys.
Any other question, please? Okay, in the absence of any other question, I want to thank all of you for paying attention. And again, I want to apologize for the network tussle today. We believe that it may not continue like this going forward. It has been a really serious tussle for us to be able to withstand the network problem today. So have a nice day and thank you for listening.